So let me start by just giving you some pretty basic forecasts. We don't think the Reserve Bank's going to move the cash rate for quite a while. The market is giving 100% chance of a rate cut by February next year, and then a 50% chance of a second cut by around June. It's giving a 40% chance of a rate cut by the end of the year. So these numbers are quite contrary to where the market is currently expecting things to go. But it's my view that the case for rate cuts that the Reserve Bank would need to make as a result of sharply lowering their growth forecasts just won't be there in that time frame. The other important one is that the fixed rates, I think, will be rising, mainly in sympathy with what will be happening in the US. But overall, interest rates since the GFC have been lower and are very likely to remain much lower for a much longer period for reasons that I'll discuss in a moment. And finally, the Aussie dollar, which ticked up to 72 cents this morning. I'm expecting it to be back at 68 cents by the end of the year and down to around 66 cents at some stage in 2016. Let me give you one main reason why I think the Aussie dollar is going to come down, and it's around our key commodity prices. What we expect to happen with the big commodity producers, particularly iron ore. If you take BHP's results, in 2014 they made $12.1 billion out of iron ore, and in 2015 they made $6.9 billion. A big fall, but given how far the price had fallen, if they'd done nothing with their business, they would have only made $3.1 billion. So and the reason that they would have only made $3.1 billion is because of the huge fall in the price. So how do they go from 3.1 to 6.9? Well, they smashed their costs. They made $2 billion by bringing their costs down, and they also ramped up their production and made another $1.8 billion by producing more iron ore despite the fact that prices were lower. And I think that's going to be an important trend that we'll see going forward. In other words, these big producers globally responding to the fact that the sales price is coming down, being even more aggressive with their costs. And if they can still make a decent margin, then they'll ramp up their production as well. So if it's correct that the BHPs and the Rios are now able to dig their iron ore out of the ground and bring it to market for about $28 a tonne, and the Chinese price is holding up at 56, then they will be ramping up their production. And I think eventually it'll mean that those prices will start to come down again. If we do start to see another round of falling iron ore prices, then that'll bring down the Aussie dollar fairly smartly. That would be one of the factors behind the Aussie dollar falling. We have seen a lot of volatility in equity markets recently. Question is, which markets are overvalued, which markets are undervalued? Our view is that the resource sector remains overvalued, and the financial sector is about back at fair value at the moment. So the general story with the equity market, I think, will be a story of two different major sectors, with the resource sector still remaining under some pressure. Let me now make a couple of comments about the US. The US economy is doing remarkably well. We expect that next year growth will be up around 2.8%. If you look at their unemployment rate, before the GFC, the US unemployment rate was a little below 5%, and immediately after the GFC it got to 10%. And since then they've been very successful in bringing that down now to 5.1%. That is pretty close to what you would call full employment. It really does raise the question as to why you would have zero interest rates in an environment when you're back at full employment. Some people argue that it's because inflation remains low, but main reason why inflation has been low in the US has firstly obviously been oil prices, and secondly the strength in the US dollar. It's unlikely that we'll see another sort of fall in the US dollar in the way we've seen in the past. And the Fed, for instance, calculates that if you have core inflation currently around 1.2%, if the US dollar was to stabilise, that would very quickly pick up to the 2%, which is the Fed's target. So even though the market believes that there's no chance of a rate hike in December, I think they've got that one wrong, in the sense that the slowdown that we've seen in jobs growth in the US in the last couple of months is really just reflecting the fact that the economy is starting to mature in that market. You know, when you have a quick expansion, you do get a sharp rise in jobs growth, but when you start to reach that full employment level, it gets a lot harder to print that 200,000 plus jobs. And I think the Fed understands that. So my view is that we will see a rate hike. A couple of other ways we look at the state of the US labour market. That red line there looks at job vacancies, which is another measure of the strength of their labour market. And you can see the job vacancies are up 22% over the last year and are now significantly higher than they were before the GFC. So the jobs market in the US is incredibly vibrant at the moment, and it's my expectation that that'll be the key factor behind the decision to start moving on rates. As I pointed out, the US dollar and the Aussie dollar tend to move together. So the grey line there looks at the Aussie TWI and the red line looks at the US TWI inverted. So obviously they're the mirror image of each other. If you invert one, you can see how they link together. And the couple of points I wanted to make there, the first one is that the US dollar has come off has appreciated a long way, something like 25 to 30%. So most of the big movement in the US dollar is behind us. So a lot of the drag we've seen on growth in the US from the strength of the currency, I believe, is behind us. In fact, you only really can go back to that period in the late 1990s, the so-called dot-com bubble period, when the US dollar was stronger. And some of you may remember that time when the euro was 0.8 of a US dollar, when if you weren't in the US, you had absolutely no prospects of growing ever again. It was that strong, the strength of people's confidence in the dot-com era. I don't think we'll go back to a US dollar story like that again. For instance, the euro was about 112, and I don't think anyone would expect it to go back to 80. So we're nearing the bottom, we're nearing the peak in the US dollar, and that's why we're nearing the peak in the the bottom in the Aussie dollar. The movement from 71, 72 down to 66 is a pretty modest final leg of that major move that we've seen from 110 down to 71, 72. So whilst we're not at the end point yet, most of the damage in that, or most of the benefits that have been derived in Australia, or the damage that have been done in the US has already been accumulated, rather than expecting another major move. So what does all this mean for markets? Well, my view is that markets are still quite complacent for the US. If I look at where the market is expecting US interest rates to go, by the end of the year they're expecting the rate to be 0.185. Now the starting point is 0.12, so they're saying 6 basis points of tightening by the end of the year. If they move, of course, it'll be by 25, so 6 divided by 25. They're only giving about a 20% chance of a hike in December. My view is that it's more like a 80% chance. Next year, they're saying by the end of 16, the rate will be 0.6. So that's saying that from 0.4 that I expect to 0.6, only one hike next year. To me, that's complacency. To me, that's really saying, gee, interest rates in the US are going to remain incredibly low, even lower than is realistic given the change that we've seen in the world. And by 2017, that's 2 years away, they'd be expecting the rate to be 1.1. So if I'm right and we get a tightening in December of 0.4, the starting point will be 0.4. That's saying that over the next 2 years, the Fed will only be tightening by a little more than on 2 occasions. At some point, the markets will wake up to the fact that yes, we are in a lower interest rate environment, but no, we've over-adjusted to how low we think rates can go. Particularly if I'm right and the US economy is growing by 2.8% next year. And that, of course, will have a number of ramifications around the world for equity markets, for currency markets, etc. just take a look at the previous 3 tightening cycles in the US. So the grey line looks at the movement in the US in the 1994 tightening cycle, went from 0 to 300 basis points in about a year. In the 99-2000, around about the same amount, once again over about a year, and in the 04-05, a similar movement. So in the past, tightening cycles have been very short and sharp, and whilst I don't expect this cycle to look like those, the idea that it'll be virtually nothing happening over a long extended period, I think is overly confident about how that interest rate environment is going to evolve. Having said all of that, there are some genuine reasons why the market is not completely wrong in expecting to see a different style of interest rate environment. If we look, say, at the average inflation rate in the US before the GFC, about 4%, and average growth about 3%, and average bond rates a bit over 7%. So the general rule of thumb, growth plus inflation equals your bond rate, was certainly working before the GFC. Since the GFC, we expect average inflation to be around 1.75 to 2, so much lower, and also growth to be lower on average over the period of about 2. So that would tend to mean a bond rate of about 3.75, 4. At the moment, the market is expecting much lower bond rates than that. If they're expecting a cash rate of 1% over the next 2 years, that suggests they're expecting a bond rate of not much higher than we've got at the moment, maybe 2.75 to 3%. So the markets are have adjusted too far in terms of their expectations. But from the perspective of people operating in the markets, the general message as to why are interest rates so much lower post-GFC than pre-GFC, and it's mainly because both inflation and growth are expected to remain lower. And why is that? In my opinion, it's been this massive build-up in debt that we've seen since the GFC. So the household, if you take the US, household debt lifted dramatically in the lead up to the GFC, and there's been very little progress in bringing that down since. Government debt lifted massively, and if you have a lot of debt in the private and the public sector, it acts as big headwinds to growth. And if growth is slow, that creates bigger output gaps, and it means that there's ongoing downward pressure on inflation. Australia's no different. If we think about debt in the Australian household sector, huge build-up from 100% of GDP, of disposable income, to about 160%, and very little progress has been made in bringing that back. So if we are in a world of much higher debt in the developed world that we have today, and very little sign that this debt is starting to come down, then that does mean that your growth and your inflation story will remain constrained. So that's why it is reasonable to believe that the outlook going forward will be for lower growth, lower inflation, and therefore lower interest rates. But what I'm saying is that the market has probably adjusted too far in that expectation. Similar story for Australian government debt. If we look at Australia's total government debt, now running at about 25% of GDP, having been negative pre-GFC. So this build-up in debt has been the main story why we can feel confident that interest rates are going to remain low, but my view is that the outlook for the US is overly confident.